The pound has remained strong against the US dollar recently, despite the fact that we've seen a little bit of a rebound in the greenback on the back of higher interest rate expectations, not necessarily over the short term, not seeing a higher terminal rate per se, but higher expectations towards the end of the year, which means markets are now factoring in fewer rate cuts from the Federal Reserve because inflation has remained a little bit stubborn. But in the UK, it's been a different picture altogether. It's not a case of just inflation remaining stubborn. Inflation remains very high and the labour market remains very tight with high wage growth. We've seen that from the economic data this week. The labour figures released on Tuesday, we saw high wage growth, both in terms of including and excluding wages. We didn't see much movement on that front, and that made investors a little bit nervous. And then on Wednesday, we saw the inflation data. CPI inflation remained above 10%. It was expected to fall just shy of 10%, and that just reaffirmed people's fears that inflation is going to be extremely stubborn on the way down, especially when food inflation was such a core part of that number remaining as high as it did. The good thing is that inflation is still expected to fall rapidly over the course of the next 6 months. The bad news is it may be a month or two before we actually start to see that come to fruition. And what that ultimately means is pressure is on the Bank of England to continue raising rates, even if it believes that inflation is going to fall rapidly and sustainably. It's extremely hard to justify pausing interest rate hikes when inflation is above 10% and showing little sign of abating, and when wage growth is remaining very strong. So 25 basis points is now fully priced into the markets from the Bank of England at its next meeting. But what's more is, and this is where the biggest shift has come as far as interest rate expectations are concerned, 2 more rate hikes are expected to follow that over the course of the rest of the year. Now, this may be a little bit of a step too far, and it seems that investors want to see signs of inflation abating before that changes. So the Bank of England is still expected to be extremely active at this stage. Once inflation starts to fall, and if it starts to fall as aggressively as the central bank and other forecasters expect, then I expect that will be pared back to some degree. But at this point in time, the economic data this week has not been helpful. And to back that up, the economy has been more resilient. The economy did not fall into recession in the final quarter of last year, and it's not expected by many to fall into recession again this year. We're not expecting much growth, of course, but the economy is expected to remain resilient. And that means that demand is going to be supported to some extent. And therefore, that could potentially mean longer inflation in terms of the remaining high, which is going to produce a problem for the central bank. What's interesting also is that the Federal Reserve is still got a job on its hands. We're still getting a lot of hawkish commentary from the central bank. Inflation has come down far from its peak, but there's still a long way to go, and there's still pressure on the Federal Reserve to continue to raise interest rates. But what I expect from the Federal Reserve still over the course of the next couple of months is, once we start to see signs that credit conditions have tightened considerably in the US, and we're starting to see early signs of that, once we see signs that lending is holding up, or that lending is starting to struggle and suffer, and once we see further signs that the labour market is weakening, all of which we expect to see over the course of the next couple of months, that's when we could see the Fed pivot. And I think this has always been the plan from the Federal Reserve, to pivot at the last minute and to pivot hard. And that markets are already pricing a lot of that in. But if we see that further priced in over the course of the next couple of months, once we start to see that materialize, and once we start to see that come through in the data, that could potentially lead to some softness in the US dollar. And on that front, let's take a look at a chart. We've got the pound dollar chart in front of you. As you see, both currencies have performed relatively well over the recent days, but the pound and the US dollar against each other have stabilized. The pound has held up against the greenback, and it's held up around an interesting level. We've seen some consolidation in the pair really throughout the course of April. What's interesting here is that we've remained above the 2 key moving average bands, the 200 233 day simple moving average band and the 55 89 day simple moving average band. It's also held above the 50% Fibonacci retracement level. Now, one of two things could ultimately happen here. We could see a break through the recent peaks that we've seen in April, which could potentially see it gravitate towards that 61.8 fib level, and above you've got a key obviously area of resistance as well. You can see the red line here around 130 is a very notable area of resistance. resistance. Of course, we're still a far away from that at this point in time, but we're just highlighting significant levels of resistance here. Or in the shorter term, if we do see a move back below that kind of 123.50 level, that is the lows that we saw in mid-April and a couple of days ago, then we could potentially see a break of a little double top formation that have formed over the course of this month. And that could potentially produce a little bit of a correction in this currency pair, taking us back towards that 55-89-day simple moving average band. Like I say, a lot of ifs, buts, and maybes, and a lot's going to depend on the economic data here. But one thing is clear. Over the next couple of months, we are going to see a lot more detail in this economic data. A lot more information is going to appear, whether these central banks are starting to achieve their inflation targets, whether favorable base effects is going to produce a sharp decline in these inflation numbers, and whether we're going to see that sudden sharp pivot that I expect to see from the Federal Reserve, and potentially then rate cuts being priced in for other central banks later on this year, and further priced in for the Federal Reserve, where we're already seeing that happen from that central bank, and what that ultimately means from tight credit conditions for the economy over the course of the rest of this year.